we broke some news about a fund called Situational Awareness LP. I just want to preface this by saying we want every fund to succeed. Nobody has any shot in fraud here. We like the fund, and we hope it goes up to the moon. But Godel is a news company, and we do provide news when we hear it. We reported that two different reports. In between our reports, the Financial Times also made a report. But basically, we learned that the fund had some large losses, and it's still unclear exactly what's happening. Situation is fluid, as it were, and the firm is called Situational Awareness, and it has a position called Fluid Stack. So all the more puns here, but in all seriousness, the fund is down at least 30% for the month, which is pretty substantial loss in the hedge fund world. We learned the fund was often as much as 4 times levered. The fund is or was about half Anthropic due to Anthropic's large gains. The fund may have sold off or pledged its Anthropic stake. We don't know for sure. The fund was up substantially before the beginning of this downturn, but we've also heard, this is the first report, that the fund was down as much as 50 or 80% for the month. I don't think that's right, but I'm not 100% sure. So we saw the Financial Times reporting that the fund was up as much as 400% at its peak, which I think is probably true. But it feels like the fund public equities have largely been liquidated. But if the firm has redemptions, which is typical in hedge fund land, then the fund could decide to shutter. But if it's liquidated its Anthropic stake, then the fund's back in business and can resume buying everything up. Perhaps this time with less leverage, but I don't know. That's what we know. A lot of rumors about how bad this month was for them, anywhere from 30 to 80%, we've heard. Certainly the private book is marked at last sale, so the private book isn't moving. So the public book would be down double, roughly, what the public book goes down, including as much as, potentially the public book being underwater. Now, I don't have any reason to believe that's true, but I'm sharing the information that we're hearing just for transparency's sake. We saw some erratic moves in different stocks. Let's take a look. Bloom Energy in particular. Now, most stocks in this space look like this stock chart. Bloom had a pretty incredible quarter. I actually just bought a little bit for transparency's sake here. But you see the stock was, a $24 stock. It's one of Situational's largest holdings, got up to all the way to 350 right around the end of June and began to plummet, down about 50% from the peak. But, not uncommon in bubbles for stocks to behave like this. It doesn't, not really clear that there's any forced selling here any more than any other stock. Intel also viciously sold over the last, period here. Also long this stock, but this is the whole sector. So I don't know that one fund, even if levered, if the private part was levered 4x, that's still $40 billion, which is relatively manageable. There were also many other Leopold copycat funds. So several funds that were, in essence, very similar, levered long bets on AI. And, we're AI bulls over here. So, we, again, have no ill will towards anybody betting on AI. We think it's the most important technology in history. So we want everyone to win, but not everyone will win, especially, with some of these large moves. And again, we have been told the fund is still up substantially year to date, which we believe is true. And there is still, time and potential for the company to rebound, potentially bet on a big comeback, potentially raise some new capital. Again, rumor that they have liquidated their Anthropic stake or pledged it in some way. In that case, in that case, again, it's not really clear what's good for the market or what isn't. Sometimes the market, in my experience, whether it's long-term capital management, Amaranth, certainly the great financial crisis, the dot-com bubble, the market likes to see carnage and likes to see a player carried out before resuming. So in some ways, there was some traders I was talking to sort of were almost relieved not to see another investor go belly up, but we're almost looking for that catharsis of another investor getting liquidated. Again, if the firm's still operational, still wants to make a big heavy bet on AI, I think it now has the means to do so. The fund could still have as much as 20 billion, we're told, which is a huge amount of capital. Still would rank it as one of the biggest hedge funds in the world. And so if liquidating Anthropic to buy public equities is what's going on, then that could be a strategy that works. We don't know. At the same time, the public markets have been shellacked. And again, when the market has this thing when it senses leverage, is kind of a bit of a spooky action at a distance. But sometimes when the market senses leverage, it tries to find the max pain point for that leverage. And, there's no sort of cheating the stock market. There are maybe some people who bought these names and liquidated at the top. But, my experience is that, the top sort of never comes for some folks. And, taking money off the table is something you rarely see in bubbles. There were some hedge funds that were short. I'm aware of some hedge funds that are up over 50 or 60% this year that caught the short of this bubble. We'll keep bringing you information as we hear it. In the meantime, we were seeing a rebound. Again, if there's oftentimes if somebody's been liquidated, who had a large leverage position, there's kind of this vacuum event that occurs that, we used to call it a long time ago that shooting against was the term used. So if there was a fund that was liquidating I know Jim Cramer, when I worked there in 2000, the concept from many different hedge funds, I'm not saying Jim did this, I don't recall, to be frank, but a fund was closing that they would quote unquote shoot against the fund by trying to short, and pressure any stocks that need to be liquidated. So the rumors of a liquidation alone can spread and cause a fire sale. And that's maybe partially contributed to the nervousness around some of these companies, stocks and so forth. And again, the fundamentals of the situation haven't changed very much. If anything, they seem to have improved slightly. But recall that, many of these companies, cyclical companies, they tend to lose money in bad times. They look great at the top. They look like they're trading at 2 or 3 times earnings. But the reality is that, looking at these stocks with a lens that's very sanguine or rose-colored is not healthy. For example, one forgets that, earnings at the peak of the cycle tend to be obscured by fresh CapEx that goes to increasing capacity that will cause a depression in earnings for the next several years. So the free cash flow at the peak of the cycle is often overestimated by EPS. And when that capacity comes online, that has to get depreciated. So, not so simple Can't really look at PE ratios there. You know, what else should I say? There's often a mistake of taking a super cycle or a high period of growth that's going to revert. There's a big AI build out right now, but it's not clear that that peak can be sustained. So maybe the better way to look at it is as an area under the curve of earnings. You know, if you do a DCF and you make the assumption that, you know, this earnings bolus, you know, will continue, you know, it with some terminal value. That's a good terminal value. Perhaps this is a normal terminal value, and perhaps this is a conservative terminal value. The reality is that maybe it's more prudent to assume that we get a increase followed by, you know, a normality, and then from here you can make your terminal value decision. And I think that's kind of the big delta, is that, you know, if you try to extend earnings from before, you know, that there's a semiconductor or cyclical peak, and this applies to PC processors, any other, you know, data centers, you know, that, you know, taking the terminal value from this is not correct. Remember, companies are simply discounting machines. Company stocks are discounting machines of future cash flows. So this area under the curve of this boom is real. We know that. But it does not represent kind of this bigger, you know, tail, which, you know, again, earnings, you know, do compound. So the assumption that you know, two rows colored, that earnings grow, earnings never decline, that, you know, they simply just grow more slowly. And that super growth period doesn't become, you know, a negative growth period. So, you know, the earnings returning to, say, half of the cycle and then growing from there, you know, this is even still an aggressive assumption. But if you call it, let's say, purple or blue, I suppose, this is what, you know, some assumptions are, but you certainly can't make this assumption, I'll color it in red, that you're going to get that area under the curve. So be careful what you assume. And of course, there's some people that would say that actually what you're going to get is this really bad sort of area under the curve that looks more like this, or, you know, really aggressive, and then you'll start growing from there. And maybe we'll color that yellow so you can see it. So it really depends. You know, it's very unlikely that you get the crazy cycle, which is you grow really fast, plateau for a bit at the peak of the cycle, and then keep growing. That sort of has never happened. There's always some reset. You know, so some hard landing. So I just, you know, keep that in mind as we proceed through this.